Welcome to the Dallas Property Insider Real Talk on the Go, where we bring you real conversations in real places about real estate, lending, and everything in between. I'm your host, Vijay Muthuraman, and today we're kicking off episode 1 with someone special. We're not in a studio, we're out in the field, grabbing coffee, hitting the road, and walking through a home, just like I do every day as a realtor here in DFW. And I've got my go-to lender, Joel from Neil Loans, riding shotgun with me to break down what first-time home buyers really need to know in today's market. From how much you actually need to pay for a down payment to how to avoid rookie mistakes, we're covering it all. So grab your coffee, buckle up, and let's hit the road. You ready, Joel?
Let's do it.
All right, so we're starting off today at our favorite coffee shop here in Arlington that Joel and I are, almost every week we're here. And for some reason, Joel, I always end up calling this place Jeremiah.
Yeah, it's close. It gets mistaken for that, but it's Nehemiah.
It's Nehemiah. And what better place than to start here, grab a coffee, and talk about the most often asked questions about what do I do as a first-time home buyer? What are the things that I need to keep in mind? How do I get the best deal as a first-time home buyer?
Yeah, so I think one of the best things that we can do is let's start off with what does a first-time home buyer do if they want to purchase a house? So where do they start? I'm going to be a little bit biased. I think they should start with a mortgage advisor, but a lot of realtors think they should start with them. So for me, when it comes to a first-time home buyer, it's never too early to sit down and talk with someone. In my opinion, if you don't prepare or plan, prepare to fail. So I sit down with a lot of first-time home buyers that may be 6 months to a year out. And when we go through that conversation, we can have realistic expectations on what do they have to have saved. We'll talk through that. What's their monthly payment going to look like? And then the big one is like, hey, is there anything on your credit report that could be hindering you in the next 6 months to a year that we could fix right now so that you're in the best position to be able to buy?
I don't necessarily disagree with that. Yes,
Okay.
Even when home buyers come to me as a realtor, right, for the first time, what do I do? After my initial conversation, I bring them to you as a lender to understand their finances. But here's the thing, not every lender is you. Not every lender wants to do the work that you do with my clients. They don't go through a conversation with them in a way where you are trying to understand what are their dreams, what are their goals, and then respond to them with, here is how you meet your dreams and goals. Most lenders don't do that.
Yeah.
So yes, if you were to find a lender who can sit with you, understand your needs, and then explain to you your finances and what may or may not work for you, then yes, that would be the first step. If not, go to me first as a realtor where I've already put together the experts in the industry that I want my clients to work with because they provide the best service, and then I send them over to a lender
100%.
to have that initial conversation. Does not mean that you have to finally do your mortgage with Joel.
Correct.
End of the day, you would still shop for the best rate, whoever gives you the best rate. But I have my clients start with Joel so that he can help them with the finances. And of course, he gives them the best rate, but you're still welcome to shop around with other lenders.
So that's a great one. One of the biggest myths that I get from a lot of people is, well, I've got to have 20% down to be able to purchase a house. Well, a lot of our parents had 20% down because those homes were $100,000 or $50,000 when they first bought. So really, when you're looking at it, if you want to think of like rough math of what it would look like to have in your pocket is, I would say 3%, you can go with the minimum down at 3%. There's also options that you can have that or down payment assistance depending on where you're at. There's also grant funds. But I would say if we take 3% of 300,000, that's $9,000. If we want to do 3 to 4% of that as well for closing costs, which right now in this market, I can't tell you how many people that we have that are actually getting their closing costs covered. So we'll just take that with a grain of salt, but you can get 3 to 4% of that for your closing costs. So you're looking at another 9 to 12 grand on top of your down payment. So you're looking at anywhere between 18 to 21,000 to get you into a $300,000 house. So every house is going to be different. Every loan program is going to be different, So it just depends on the client and their situation.
So 3% is the lowest they can do.
So technically you could go lower. If you're a veteran, you can go 0% down. You could go USDA, but that has to be a specific property that is eligible outside of the city limits. You can look at a USDA eligibility map. That's also income driven as well. And then you have down payment assistance programs. One of the big ones in Texas is called TSHAC, and you can utilize that. But what I tell people is money is not free. Down payment assistance isn't free. They're getting you either on the rate or they're getting you paying back that down payment assistance.
And that's where, as a realtor, I tell my clients the price of the home is not necessarily the primary focus. I tend to shift focus to the monthly payment.
100%.
Right? I think it really depends on you and what your needs are. If really monthly payment is not a problem, then great. We look at the cost of the home and how do we negotiate that. But for first-time home buyers, it's usually the monthly payment. And therefore, we talk about things like, how much do you put down? Do you have enough money to put down?
Yep.
Right? So for some clients, it's, hey, I don't have the money to put down. And they're okay with doing the lowest down payment and the higher monthly payment. But there are other clients who have the cash to put down. They're smart buyers, even though they're first time, they've saved up. But there are also other opportunities where a lot of people are sitting on a ton of equity on their homes, and therefore if you have kids who are first-time home buyers, there are different ways of helping your kids use that equity, but we'll get to that maybe in another episode. But staying on track, some first-time home buyers don't have that down payment, right? So therefore the monthly payment becomes very important. That's where the interest rate, and when you're buying homes that have an HOA, things like that quickly add up. So we keep focus on that monthly payment based on your needs.
Yeah, the majority of lenders are going to pre-approve you for a house purchase price. In reality, we don't do that. When it comes to your debt to income ratio, it's based off of the monthly payment. So make sure if you're talking to a lender, they're not pre-approving you based off of the house price. They're pre-approving you based off of the monthly payment. It really depends monthly payment wise too. You want to make sure you have a good estimate on taxes and a good estimate on insurance. If you're Zillow surfing or if you're on Realtor.com and they just input all that information in their mortgage calculator, 9 times out of 10, their insurance is super low.
Yeah.
Their taxes are super low. So what they're saying you actually qualify for that monthly payment wise, when I talk to clients, they're really kind of upset when it comes to that. So in my opinion, go to somebody who's knowledgeable in that market to give you realistic expectations. Don't rely on Realtor and Zillow.com, who are literally, you're not the consumer. They're basically selling your information to.
It's interesting. This happened exactly to a client of mine yesterday.
Yeah.
He was looking at investment properties, found this property on Zillow, sent it to me, and he said, hey, could you do a rental analysis for me? Sure, no problem. And then he looked at the mortgage payment on Zillow and thought that was it. But the insurance costs were very low and the property tax was very low as well.
Correct.
Yeah, so Zillow is great for you to find properties that you like, but may not be the place you want to calculate your mortgage.
100%.
All right, so let's head to the car and take a drive. So when it comes to buying a home and finances and credit, there's just so many different things, right? So what is more important for a first-time home buyer? Is it the credit? Is it the debt? Is it their income? What do you think?
Yeah, so it's a really good question. One of the big things that I really do is I kind of weight them differently. So for me, the most important thing, which I think can clear up things, is your income. If you have a good income, you can overcome low FICO by making sure that you're paying off your credit or establishing a credit line. And then 2, when it comes to your debt, if you have a good income, you can work to pay off your debt. So for me, biggest one is going to be income. Next one I would probably say is debt, because you may have a lot of debt, but if you have a lot of income, you can overcome that debt, which in return is going to move your FICO up. So I would go income, debt, FICO, because if you have the income, you're going to be able to pay off the debt, and then your FICO is going to adjust accordingly to that. So personally, I would say income is going to be the biggest thing.
But there are other things that impact the FICO score, right? Besides just income and debt.
Correct. What things that are going to impact is, okay, do you have any lates on your credit report from, say, a car loan or a student loan or a credit card that you opened up in high school? I can't tell you how many people that I have figured out when looking at their credit report, they had a credit card from high school and just missed the payments on it. If you don't have any type of debt, it's a game. credit is a game, and you have to play the game to be able to purchase a house, unless you just got bukus of money. If you got bukus of money, you ain't gonna talk to me. But when it comes to the credit aspect and you have no trade lines, one thing you can do is you can be an authorized user on your parents' credit, because the biggest thing when it comes to credit is time. Younger people don't have a lot of time of having credit cards or having a student loan or everything like that. So authorized user. Or two, if you can't qualify for a regular credit card through, say, Citi, Chase, or whatever, you can get these things called secured credit cards. Secured credit cards, basically, you sign up, you take, say, $300 or $400, you give that money to that creditor, and that money is basically backing all of your payments. And then you continue to make that monthly payment every single month.
So you're basically just using your own money as a line of credit.
Yep. Mm-hmm.
Okay.
Correct.
Nice.
Yeah. And so that one, you don't need to have any type of history of credit, and I can help you get set up on that. And really, it's just how long can you get into the credit game to get your score to raise.
Very nice. And since we're talking about credit and approvals and stuff like that, this other thing came to mind. In mortgage process, in the process of shopping for a home, people generally hear about pre-qualification, pre-approval. What is that?
Yeah, it's a really good question. I think there's kind of a misconception on like a one size fits all scenario when it comes to that. I break it down into 4 different scenarios. So your big box lenders, say, the one that's got a rocket ship with it. When you do an application with them, they will do a credit approval. So the credit approval is they are literally giving you a pre-approval letter based off of just running your credit. In my opinion, it is horrible. Then you have another one that is more of like a pre-qual. A pre-qual is basically they're taking your stated income and they're taking your credit score and they're giving you a loan off of that. In my opinion, is wrong. You're not getting the full picture of the file. Then the third one is a pre-approval. A lot of people think a pre-approval is the best one to get, but really it's not. A pre-approval, which is better than the other two, it checks your income, it checks your credit score, and then they run it through a system called AUS. AUS is an automated underwriting system that every single lender has to run their files to for Fannie and Freddie. So after they do that, they'll give you a pre-approval. And out of those 3, that's the best one. But the real one that is really gonna move the needle, it's gonna help you negotiate better and look like cash. And the reason why I say look like cash is 1 out of every 3 homes in 2025 sold for in cash. So if you're a financed buyer, how can you compete with cash? Because cash can close in 15 days. The average buyer that is financed is going to have this thing called a financing contingency. A financing contingency is basically after you go under contract, the underwriter has to check the loan and give you the thumbs up. Most financing contingencies are anywhere between 15 and 21 days. So really, if that seller accepts that offer that's got a financing contingency, they will not know until 15 to 21 days after that offer is accepted if that client actually qualifies for that house. So what we do on the front end is we do a fully underwritten loan up front.
That's awesome.
So when we do that, we're getting all of that information up front before you even put an offer in on the house. So the underwriter who holds the keys to the bank vault is checking all of your stuff. We're running AUS, we're checking the guidelines, we're doing everything so that one, when you put in an offer, you can close in 15 days or less. You're looking like cash, but also a finance buyer who is fully underwritten compared to a cash buyer. Cash buyers notoriously are going a huge haircut off the purchase price of the house. So if you're a fully underwritten loan buyer, you look like cash, you can still get negotiations in there, but you're not going as deep as the cash buyers. And with that, we have seen an acceptance rate on those offers 75% more by being fully underwritten than not doing that.
That's awesome. And in a real estate contract, there are so many different contingencies, right? There's the finance contingency, there's an appraisal contingency. If you think of it from the perspective of the seller, what do they want? They want certainty, right?
Yep.
And they want a shorter time to close.
100%.
So if you don't have cash, and if you can look like cash, then you have the upper hand in negotiating the deal, and you can close sooner. So which offer do you think would the seller accept?
And also think about it too. If you're going up against other finance buyers that still have a financing contingency, say this is your dream home and it hits the market
And if it's your dream home, it's probably going to be the dream home of other people as well. But if you have, say 5, 6 different offers, a cash offer who's given, wanting $100,000 off the purchase price, you have 3 other finance buyers that have a financing contingency of 15 to 21 days. And then you have somebody who's fully underwritten that looks like cash. They'll close in 15 days and they're giving a little bit more of negotiations on that, less than what the cash buyers are asking for. And then compared to the finance buyers, it's a no-brainer. The sellers, like you said, they want certainty. They want to know that this loan is going to close, because the longer they hold that house, the more monthly payments that they have to have. So it's a big deal. And so the majority of lenders do not do a fully underwritten loan. And the reason why is we have to basically pay out of our pocket to our processors, our underwriters, our loan specialists, our production partners. We have to pay out of pocket for them to do the work on the front end, because like you and me, we don't get paid unless we get to the closing table. So for us, paying money out of pocket on the front end, we are more than willing to do that, but there's a cost to us when it comes to that. So we just want to make sure that we're a good fit for that buyer and for us. And if you want to shop with other lenders, totally fine. Come with me. I'll give you a list of 10 questions that you can ask every single lender that you go to that are going to give you realistic expectations on what they can actually offer you. Because the majority of people think rate is the biggest thing that matters. Well, the lowest rate usually has the highest cost. And you want to make sure that whatever cost that I'm having, figuring out where my break-even point is so that I'm not overpaying on my house when rates continue to drop.
And there are a lot of those fees and things like that in a loan estimate. In a future episode, we'll talk about that and we'll help you understand a loan estimate and how to look out for things like hidden fees in there.
Yep. If you guys have anybody that is going through the home buying process right now and they're unsure of that, send it over to VJ, send it over to me. We'll walk you through that loan estimate, regardless if you use us or not. We just want to be a resource for you guys. If you need any help, just get with us.
Yeah, you got all our contact information below. You can also click the link in the description below and book a direct appointment with me, and we'd be happy to help out.
So when it comes to certainty, sellers want to be certain that if they accept an offer, that there are minimal chances for that loan to not be approved. So when you're comparing a cash offer who can close in 15 days, but has a severe price cut on the house, compared to a financing offer that has a financing contingency of 15 to 21 days, if the sellers accept that financing contingency offer, they will not know if that loan is going to close 15 days before they close or 15 days after they accept that contract. So by getting the loan fully underwritten up front, the underwriter is checking it. He's checking the income. He's checking the assets. He's running AUS. He's making sure that the letter of explanations are good. The written verifications of employment are good. We lift every single stone. We dot every single I, cross every single T, because we want to make sure that when that client has that offer going in, there is nothing that could hold that loan from being closed, set aside from property, title, and insurance. We're removing all of the what ifs in that scenario. So when sellers look at that and they see somebody that can close as fast as cash, not asking for a discount as big as cash, compared to a financing buyer where they don't know if that loan's going to close for the first 15 to 21 days, your offers are going to be 10 times more likely selected. So in a competitive environment, depending on where you guys are putting offers in on, you could be the one that is selected over 10, 5, however many offers. Or if you find a home that, has been on the market a little bit longer, you're going to be able to get a bigger negotiation on that because you have basically a golden ticket when it comes to your offer.
What do they say? Cassius?
I have no idea.
Cash is king, man.
There we go. Cash is king. You're right.
Cash is king. If you don't got the cash, he'll make you look like you got the cash. So
yeah, exactly. So VJ, where are we at?
This is Central Fort Worth. This is a community called Mockingbird Estates. It's a townhome community. There's another phase that they built previously, which was all single family homes.
Yeah.
But this is the last phase of the community they're building. all just townhomes right smack in the middle of everything. It's close to Irving, it's close to Farmers Branch, Arlington, all of these major cities that are out here. It's a perfect place to be.
Yeah, it's right next to a highway. There's a lot of local places around here, a lot of really good food places that you can literally hop right on the highway and get out of there. But it's also tucked and secluded back into a little bit of area, so you don't feel like you're right next to the highway. It's pretty secluded, so it gives you that feeling.
One way, this side is the highway. It's like literally less than a minute you're at the highway.
Yep.
And then the other side of the property is Randall Mill Road.
Yeah.
It's just beautiful. It's tucked away. It's like a serene drive.
Yeah.
Just
There's
all
horse
green.
ranches.
There's horse ranches.
Yeah.
Do you know how to ride a horse?
No, no. Do you?
No, I don't. Well, I did, right? You know, when I was in kindergarten, I did.
Yeah. Take that as a grain of salt right there. So what brought you to this area? Why did you specifically choose this area for this?
So normally when we are shopping for our clients, we don't believe in sending our clients out to go out and shop for homes and then we just help them close. We pre-shop homes for them. We drive hundreds of miles, spend a lot of hours doing that, and then we shortlist certain communities and take them around. So one of my recent clients, when I did that, this was the last stop and this was the only townhome community that I showed them. But when they saw how the drive was beautiful and this is right where they wanted an easy commute to work, they were just sold right away.
Yeah, that's
and I wasn't expecting that. And then we had another client after that. It's just been going on. It's just such a nice place. So I said, why not stop here and talk about it?
Yeah, agreed. What do you want to do next? Did you get anything?
I had no coffee. It's normally how many engineers does it take to figure out how to work a coffee machine? But he's not an engineer.
Well,
so
I'm not an engineer, so I can't answer that for you. Wanted to be an engineer, but
why not?
You had to reopen it.
Why not?
So transferring from a junior college, I didn't have enough credits to be eligible to play baseball and be an engineer.
But you played baseball.
I did.
Right?
I did.
Was it state level? Like,
so when you mean state level?
I don't know. Tell me.
Okay, so you have basically high school, then you have college. So when it comes to baseball, there's multiple different levels. You have junior college, you have D2, D3, NAIA, then you also have like major D1. So I played at a major D1 at Texas A&M.
Very nice.
Yeah.
And I was a national level champion.
There you go. Don't know what national level champion means, but that's regional.
All right. So what do you think about townhomes? Have you owned one before?
Nope, never owned a townhome.
Yeah, I did.
To me, I am more of a single family home person. One of the big driving factors for me is, so one, I have no HOA. I can paint my house whatever I want, which can be a positive and a negative depending on where you're at. Because if you're in a no HOA place, you could have $1 million house and then you could have a mobile home right next to it, which we don't frown on mobile homes, but that's also not going to raise the price of this house. Also, townhomes, really small yards. We have a dog. We didn't feel like we could ever help or have a dog.
You got a big, beautiful dog.
Yeah, got a big dog. So he needs a lot of room. He needs a lot of grass for big dumps. And, you know, for townhomes, you're lucky if you even have a yard. So they do have dog parks. Really depends, but also no yard means no maintenance. So there's kind of pros and cons when it comes to that. And the big thing for us is we really want to be able to rent our house out. So having an HOA, more than likely there's more HOAs that won't allow you to rent your house out than HOAs that do. So that didn't give us an exit plan for how we wanted to purchase. And townhomes are one, they're cheaper. So two, if they're cheaper, they're going to appreciate at a slower rate. So really, there's pros and cons to it. It really just depends on your game plan. What's your exit strategy? If you're buying a house just to buy a house and you're not having an exit strategy and thinking about the future, you're not buying a house.
That's awesome.
In the right way.
You need an exit strategy for anything, right?
Correct.
Whether you're buying a house, you're getting into a new business, a new employment opportunity, whatever it is, you always need an exit strategy. So that's a great point. But I'm surprised that your home doesn't have an HOA, because in Texas, even if it's a single family home, a lot of single family homes have an HOA, but it's not that expensive compared to a townhome. So I owned a townhome, and here's why. It was an easy entry point for me, right? Like I didn't have to pay top dollar like you would have to for a single family home, especially if it is in the, if it's right smack in the middle of everything like this one is, if you were to buy a single family home around here.
It's a lot more affordable.
Yes, a lot more affordable. For a first-time home buyer, when I owned a townhome, like I didn't want to do maintenance, right? Like I didn't want a backyard at all. I didn't have a big dog, right? if now I have a little one, I have a little Yorkie, maybe I'll throw a picture of that for you guys, and we gotta throw a picture of your guy.
Yeah.
But he doesn't need a big yard. But now I do have a big yard. That's a different scenario.
Yeah. And with that, speaking on the maintenance aspect, there's a big shortfall in clients that are moving into homes that, if you think about it, there is a manual on how to take care of a fridge, how to take care of a blender. There's a manual on how to use a pencil, but there's no manual on how to take care of a house. And that's one of the biggest things that first-time homebuyers don't think of as a cost added into, say, their monthly payment on what does it take to maintain my house. So when I go and sell it in 7 years, my house is going to be maintained and it's going to sell for more. That's one thing that we do specifically is we have a tool that sends maintenance reminders out every single month to our clients to make sure that one, they know how to maintain their house, because no people, in my opinion, are innately born with, oh, I understand how to take care of a house. So one, that sends them a maintenance reminder every single month, adds to the honey-do list. But also when you go and sell that house, say 5, 6, 7, 10 years down the road, you can print off everything that you've done to maintain and upkeep that house, give it to your listing agent. And then every buyer that comes in gets to see everything you've done to maintain and upkeep your house, which if you put that house versus another house and the same exact house, 10 times out of 10, clients are going to want the house with a maintenance history than not.
Absolutely. It's like servicing a car, right?
Yeah, 100%. Carfax for your house.
Yeah, that's amazing. Not most people don't do things like that.
Why'd you buy the townhome other than the maintenance aspect?
So there was maintenance, the lower price point, and safety. Right.
Yeah,
so townhomes are usually in either a closed community, a gated community, sometimes not. But still you got neighbors next to you, right? You've got at least one shared wall if you're a corner unit or an end unit, or you have 2 shared walls if you're kind of sandwiched between multiple units.
Correct.
So it's hard for someone to rob your house.
100%. Yeah.
Right?
And you hit on it. You talked about how there's usually gated communities for townhomes. It's one more thing that a robber has to overcome to be able to do that. If you think about it, a lot of people that are robbing homes, it's all about access. Less opportunities for them to get caught. So easier access, being able to go into a house immediately compared to, say, a townhome area or a townhome development where there's a gate. There's also multiple houses really close to each other. So
Yeah, and what's the word I'm looking for? Deterrence.
Yeah, deterrence, correct.
Right, that's all it is about when it comes to staying safe, whether it's about your house, whether you're just walking outside, right?
Yeah.
It's the same concept. So if it's a gated community, there's already a layer of deterrence.
Yep.
If there are houses right next to each other, that's another layer of deterrence, and someone's always watching out for you.
Yeah.
So I personally like an end unit. But let's talk about one of the cons, right? That could also be a con. If you have lived in apartment complexes, right? If you have had a neighbor next to you or above you, it can get noisy.
Correct.
Here, there's not going to be anyone above you because, townhomes are usually 2 or 3 story townhomes, but you'll have a neighbor next to you for sure, at least one, or up to 2 neighbors. So if, worst case, if you don't end up having a good neighbor, it could get noisy.
Yep. 100%. Yeah, you hit the nail on the head, especially if they have a little yappy dog like a Yorkie,
What?
No. But
my Yorkie doesn't bark. Maybe there are Yorkies.
Or if they play a bad taste of music and you don't like that music. So yeah, that's a great point.
That did happen when I eventually moved out of my townhome and I rented it out. One of my tenants was like that, and I got a call from my neighbor. He said, "Vijay, I barely heard a thing when you were there, and now the walls are just like boom, boom." Right?
Yeah.
So that could happen. Rentability, it's also less expensive compared to single family homes. So it's in a way easily rentable, but you're also kind of reducing the pool of people who are looking for that kind of property. So there are pros and cons to that.
Also, when it comes to rentability, okay, HOAs. If you're going to be buying a townhome, what is the cost of that HOA? Because if that HOA fee, granted, you're going to have a lower insurance fee, well, that HOA fee is going to make up for it. And if your HOA fee is so big, that's also one thing on townhomes you don't have control over. They can continually raise that HOA fee if they wanted to. So if that HOA fee is high, being able to have a profitable rental is difficult.
That's very true. But that HOA balances out your cost in a different way, right?
Correct.
In a single family home, you would end up paying for maintenance of your yard, right? I pay, about $40 every week or every 2 weeks for yard maintenance.
Yep.
I pay a very high insurance for a single family home.
Yeah.
But in a townhome, you're expected to have insurance for the inside of the property,
Correct.
not the outside of the property. So you're not responsible for the roof, the structure, which are the most expensive components of an insurance.
Yeah.
So therefore, less insurance costs, but high HOA. So it kind of balances out in some way or the other. And they don't add to the equity of your home. Whether you buy a townhome or not, even in a single family home, when you pay high insurance, when you pay high maintenance, that doesn't add to the equity of your home. Same thing in HOA, a high HOA does not add to the equity of your home
And
either.
one thing, when you're looking at townhomes and you're looking at the HOAs, walk around the property, see if they're actually upkeeping and maintaining the property, say the amenities, the pool, the gym, all those things that they're giving you. Make sure that the money that you're paying for that, it's actually going to something that's going to be maintained.
Very true.
Because if you go to sell that, say 5 years down the road, 10 years, whenever, and all that stuff's not being maintained, do you think somebody that's coming in is going to see that HOA fee and see, all this stuff's not being maintained? Are they going to want to buy that property? Probably not. They're going to go find somewhere else that has an HOA that's taking care of the amenities.
That reminds me, we're going to roll a B-roll of this community so you guys can take a look at that too.
Yep.
Let's talk about mortgage options. Are there, when it comes to mortgage for townhomes, is it any different?
Not really. It's really mainly just condos. So 0% down, 3.5% down, 3% down, any mortgage option you can utilize on it.
Very nice.
Yep.
That's awesome.
Yeah.
Hope you guys enjoyed this podcast. I'm Vijay Muthuraman with Everkin Realty Group.
Joel Davis with Neo Home Loans. And we'll catch you next week or next month.
We'll catch you next week or next month, whenever the next one rolls out.
Yep.
Like, share, and subscribe.